In 9 days, one man walks into the most powerful financial institution on earth, and what he says in his first breath could either rescue silver or bury it. There is a date circled on the calendar of every serious monetary analyst in the world right now, not in red, in something closer to the color of uncertainty itself, that peculiar gray that hangs between crisis and opportunity, between the past you thought you understood and the future you cannot yet see. That date is May 15th, 2026. And if you hold silver, or have ever thought about holding silver, or have watched silver's breathtaking implosion from its all-time high of $122 per ounce in late January down to where it sits today, hovering, wounded, and restless near $73, then what happens on that date deserves your complete and undivided attention. Because on May 15th, Jerome Powell's tenure as chairman of the Federal Reserve officially expires, and a man named Kevin Warsh, whose views on money and inflation constitute one of the most genuinely ambiguous puzzles in modern central banking, is expected to take his seat. The Senate confirmation vote is expected the week of May 11th, which means before this month is over, the Federal Reserve, that strange, powerful, semi-mystical institution that quietly governs the cost of every dollar borrowed, every bond issued, every speculative bet placed in the American economy, will have a new face at the helm. And silver, that ancient metal with a decidedly modern problem, will either find its footing or lose it entirely depending on what that face communicates. Let us be precise about what has already happened because precision matters enormously here. On January 29, 2026, silver reached $122 per ounce. It was, by any historical measure, a staggering achievement. A metal that had spent years being treated as gold's poorer, more volatile cousin had suddenly become the talk of every serious investment conversation on the planet. The fundamental story behind that rise was not manufactured. The Silver Institute confirmed that 2026 marks the 6th consecutive year of structural supply deficit in the global silver market. 6 years. The world has been consuming more silver than it mines, and the cumulative shortfall now exceeds 800 million ounces since 2021. Industrial demand from solar panels, electric vehicles, and the insatiable appetite of artificial intelligence data centers, where silver is used in power distribution and thermal management, was accelerating. The 4 largest technology companies in the world had committed a combined $715 billion in capital expenditure for 2026, nearly double their prior year spending. Silver, representing less than 1% of data center construction costs, was being bought by industrial users who were, for all practical purposes, price insensitive. And then, on January 30th, 2026, one single day after silver's all-time peak, President Trump announced the nomination of Kevin Warsh to replace Jerome Powell. What followed was not a market correction, it was a detonation. Silver fell 31.4% in a single trading session, its worst single-day collapse since March of 1980, 46 years. In a matter of hours, the metal that had made some investors feel like prophets made others feel like fools. Gold fell sharply too, roughly 9% that same day, but silver, as it so often does in moments of genuine market panic, fell harder, faster, and further. The reason was not complicated, even if its implications are. Markets had been betting heavily that the Federal Reserve, under the continued stewardship of Jerome Powell, was moving toward interest rate cuts. Lower rates reduce the appeal of government bonds. Lower rates soften the dollar. Lower rates remove the primary competitive pressure on non-yielding assets like silver. When Warsh, a man whose reputation as an inflation hawk was built over years of public commentary and dissent during his time on the Fed's Board of Governors from 2006 to 2011, was nominated, the market made a brutal and immediate calculation. Rate cuts were suddenly less certain, and silver, which had been priced on the expectation of those cuts, collapsed. That is where we are. Silver at $73 an ounce, a metal with magnificent structural fundamentals, sitting in a ditch dug not by its own failings, but by the shifting expectations of monetary policy, in a world where one man's philosophy about inflation can move a commodity by 30% in an afternoon. What happens next is the question. And the answer, uncomfortable as this may be, is that nobody knows with certainty. What we can do, what responsible analysis demands, is understand the terrain, map the possible paths, and recognize which signals will tell us which path we are actually on. That is what this is about. If you want to understand markets the way the professionals actually do, not the version sold to you in headlines, but the version that actually drives decisions, consider subscribing. What comes next in this story is exactly the kind of analysis that most financial media never bothers to make. Stay with it. Kevin Warsh is 56 years old. He is a former Morgan Stanley executive who joined the Federal Reserve's Board of Governors in 2006, served through the most catastrophic financial crisis since the Great Depression, and left in 2011 with a reputation carefully assembled from dissent. In June of 2008, with the American financial system already cracking beneath its own weight, Warsh told his colleagues at a Federal Open Market Committee meeting that inflation risks, in his assessment, remained the greater concern for the economy. This was not a fringe position. Reasonable people disagreed about the precise balance of risks in that moment, but it established Warsh as someone who, even under duress, prioritized the fight against rising prices over the comfort of easy money. In the years after leaving the Fed, he became a fellow at the Hoover Institution, a conservative think tank, and spent considerable intellectual energy criticizing what he viewed as the distortions created by the Fed's prolonged experiment with near-zero interest rates. And yet, the Kevin Warsh who appeared before the Senate Banking Committee in April of 2026 was not entirely the Kevin Warsh of 2008. At his confirmation hearing, analysts from Invesco noted that his approach had grown, in their characterization, increasingly dovish compared to his earlier tenure. He drew careful distinctions between demand-driven inflation, the kind produced by too much money chasing too few goods, and supply-driven inflation, the kind produced by a geopolitical shock like the closure of the Strait of Hormuz, which has kept oil prices hovering near $100 a barrel and injected persistent upward pressure into inflation readings for weeks. He argued that the Federal Reserve should not be setting long-term policy based on temporary price spikes caused by wars or supply disruptions. He invoked the theory, not entirely without merit, that artificial intelligence-driven productivity could serve as a disinflationary force, that a more productive economy could sustain lower interest rates without igniting the kind of inflation that erodes purchasing power. It was, in substance, the same argument Alan Greenspan made in the late 1990s when he allowed the American economy to run hotter than conventional wisdom suggested it should, betting that technology was rewriting the rules. Deutsche Bank analysts, however, were unmoved by the rhetorical evolution. In a research note following the hearings, they maintained that they do not view Warsh as structurally dovish, and that his historical instincts skew hawkish. J.P. Morgan's chief economist offered perhaps the most clarifying assessment. His best guess is that Warsh will make the case for rate cuts in the short term, but that over time his instincts are likely to drift back toward tighter policy. What you have then is a genuinely ambiguous figure, someone whose recent statements pull in one direction, while his intellectual history pulls in another, assuming control of an institution whose decisions ripple through every corner of the global economy, including the silver market currently sitting on its hands at $73 an ounce. There is a further complication that most casual observers have missed entirely. Warsh cannot simply walk into the Federal Reserve and decree that interest rates will fall. The Federal Open Market Committee, the 12-member body that actually sets rates, operates on consensus. The chair presides, shapes the agenda, and commands enormous influence, but holds exactly one vote. And at the FOMC's April meeting, 3 senior regional Fed presidents, from Cleveland, Minneapolis, and Dallas, dissented against even keeping language in the official statement that implied rate cuts might be forthcoming. They wanted language so neutral it kept the door open to rate increases. 3 dissents is not a murmur of disagreement. It is a statement of position. It tells you something important about the internal resistance Warsh will encounter if he arrives with ambitions to ease policy quickly. Then there is the matter of Jerome Powell himself. Powell confirmed at his final press conference as chair that he intends to remain on the Board of Governors for an unspecified period, citing what he described as ongoing concerns about institutional independence. He will become the first departing Federal Reserve chair to remain on the board since Mariner Eccles in 1948. That is not a trivial footnote. It means Warsh and Powell will be in the same room, voting on the same decisions, with Powell's continued presence serving as a quiet but unmistakable reminder that the institution has a longer memory than any single administration. One veteran Fed analyst described Powell's decision to stay as the last card Powell has to play against a White House that has spent years pressuring the central bank for lower rates. What this architecture produces is a Federal Reserve that is almost certainly going to move more slowly than either the optimists or the pessimists currently anticipate. Warsh will not cut rates immediately. He does not have the votes, and doing so in his first weeks would invite accusations of political compliance that would follow him for the duration of his tenure. He also cannot tighten policy immediately because the economic data does not support it, and because it would directly contradict what he said under oath during his confirmation hearings. The most probable near-term outcome is a Fed that holds, that waits, watches, and gives Warsh time to build internal credibility before making any dramatic moves. And here is the part that matters for silver. A Fed on hold is not the same as a Fed tightening forever. On hold means the structural story in the silver market, the supply deficits, the industrial demand, the constrained mine supply, continues to build in the background, largely undisturbed by financial market conditions, waiting for the moment when those conditions shift. That moment is not guaranteed, but the direction of travel, given Warsh's recent positioning, given the White House's persistent pressure for lower rates, given that AI-driven productivity arguments give a new Fed chair intellectual cover to justify easing, the direction of travel over the next 12 months is more likely toward accommodation than toward further tightening. Not dramatically, not immediately, but directionally. Let us be honest about the downside, because intellectual honesty requires it, and because the people holding silver through a 40% decline deserve something more useful than reassurance dressed up as analysis. The bearish scenario is coherent and real. If Warsh arrives in his first communication signal that inflation remains the overriding priority, if he aligns himself publicly with the three hawks who dissented at the April FOMC meeting, then the market's current expectation of at least one rate cut somewhere in 2026 evaporates. JP Morgan has already penciled in no new rate cuts for the remainder of this year, even with Warsh at the helm. If that projection is correct, one of the primary catalysts silver investors have been waiting for disappears from the near-term picture entirely. Silver has found technical support near $72 on multiple tests. If that level breaks, the next meaningful zone that technical analysts point to is around $54, an additional 26% decline from current levels. That is not the base case, but it is not a fringe scenario either. It would require the persistence of three conditions that are all, at this moment, simultaneously present: elevated oil prices, inflation readings that remain stubbornly above 3%, and a Federal Reserve unwilling to signal any movement toward easing. Three conditions, all present, none permanent but none disappearing tomorrow. The geopolitical dimension adds its own layer of complexity. The Strait of Hormuz situation has kept oil near $100 a barrel for weeks. Every week that oil stays elevated, it adds to the inflation readings that the Federal Reserve is forced to monitor. And as long as the Fed is grappling with inflation driven by a supply shock, it has no power to fix. No interest rate in the world can reopen a closed waterway. It will struggle to justify cuts even when it wants to. There is also a subtler, longer-term risk that is harder to quantify but worth acknowledging. If Warsh is perceived, either through his own actions or through the behavior of the administration around him, as a politically compromised Fed chair, the credibility of the dollar itself could erode over time. That scenario would eventually prove bullish for precious metals as a hedge against institutional uncertainty. But the short-term path through credibility collapse would be volatile and painful before it became profitable. And yet, every time silver has experienced a major correction inside a structural bull market, it has recovered. The evidence is not ambiguous on this point. In 2008, silver fell more than 50% during the financial crisis. It then rallied more than 400% over the following 3 years, moving from under $9 to nearly $50 by April of 2011. In 2020, silver fell approximately 35% during the initial COVID shock. It recovered more than 140% over the following 5 months. In both cases, the investors who interpreted the correction as the end of the story, who looked at the pain in their portfolios and decided that the fundamental thesis had been disproven, missed most of the recovery. The 40% correction silver is currently experiencing, from its January peak of $122 to its current level near $73, falls within the historical range of what has proven, in prior cycles, to be a severe but ultimately temporary interruption of a larger move. The structural conditions that drove silver from roughly $30 per ounce in 2024 to $122 in January of 2026 have not been dismantled by the Warsh nomination. Mine supply cannot respond quickly to price signals. Approximately 70% of global silver production comes as a byproduct of copper, zinc, and lead mining, meaning producers cannot simply open new silver mines in response to demand. The average timeline from mineral discovery to production is 7 to 10 years. Industrial demand from solar manufacturing, electric vehicles, and AI infrastructure is not slowing. None of that changed because a hawkish-leaning former Fed governor was nominated to chair the Federal Reserve. What changed was the financial market environment, the rates, the dollar strength, the positioning, layered on top of that structural story. And financial market environments, unlike geological realities or industrial supply chains, are genuinely responsive to policy. They shift when policy signals shift. Which brings us back to May 15th, and to what you should actually be watching for in the days immediately after Kevin Warsh assumes the chairmanship. Watch the dollar index. If the dollar strengthens in the immediate aftermath of Warsh's confirmation, pushing back above 98 or approaching 100, the market is pricing in a hawkish Fed. That is a headwind for silver. Watch Warsh's first public speech as chair. The specific language he uses around inflation will tell you more than anything else. Does he distinguish between supply-driven and demand-driven inflation, as he did in his confirmation hearings? Or does he revert to the blunter, harder-edged language of his earlier years at the Fed? Watch the gold-silver ratio, currently near 62-1. If silver begins outperforming gold on a consistent basis, investment demand is returning and the ratio will compress. That has historically been one of the most reliable signals that silver's recovery has genuine momentum behind it. Watch also the May 12th CPI reading, which arrives just 3 days before Warsh takes his seat. If inflation shows meaningful progress, anything approaching or below 3%, down from the current 3.3%, it gives Warsh political and intellectual cover to signal openness to cuts without appearing to be doing the White House's bidding. That single data point, arriving days before the transition, could reshape the entire opening narrative of the Warsh era before it has properly begun. Silver is a commodity at an inflection point, not just in price, but in narrative. The story that drove it from $30 to $122 has not been disproven. It has been interrupted. The question serious investors must answer, and answer for themselves based on their own reading of the macro environment and their own tolerance for uncertainty, is whether they believe the interruption is the end of the chapter or merely a pause before the next one begins. History suggests the latter. Policy trajectories suggest the latter. Industrial demand suggests the latter. But history also contains its share of moments when the expected recovery failed to materialize, when the structural story was real, but the timing was wrong, and when patient investors turned into permanently patient investors holding assets that moved sideways for years. That is the honest picture, not hype, not panic. A metal with real fundamentals sitting inside a financial market environment that is about to clarify itself in ways it has not in months, and a new chairman whose first words will carry more weight for the silver price than any single macroeconomic data point has in recent memory. May 15th is 9 days away. The ambiguity is about to start resolving. Pay attention. One question before you go, and I am genuinely asking. Do you think silver has already found its floor at $73, or do you believe we have more downside before any real recovery begins? Leave your answer below. Every serious comment gets read. The conversation in this community is one of the best anywhere, and your perspective matters more than you might think. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.